Moving on, how these assumptions are impacting our liability. So we have set an example. It's a example from a gratuity calculation. So as we were discussing earlier, so there are few of the key assumptions, right? There were seven key assumptions. Three being the discount rate, salary growth rate, and expected rate of return, which were also known as the financial assumptions. Since expected rate of return calculates the is dealing with the fair value of plan assets, so we are not talking about that. However, we will be capturing out here the salary growth rate and the discount rate. And also then there are demographic assumptions, including the retirement age, the mortality rate, and the attrition rate. So for the sake of simplicity, we have assumed that the in the current example there is no mortality rate and no attrition rate. Fine. So in this example, there is this employee. His current salary is 55,000 rupees per month, which is the monthly basic salary. His current age is 40 years. His retirement age is 60 years. Till date, he has completed 13 years of service in the organization. The salary growth rate in this example is 7.5%, whereas the discount rate is 7% per annum. So, if I would have to talk on actuarial assumptions or actuarial liability, how do we do an actuarial valuation? So, while doing an actuarial valuation, what we do is that we firstly see that what is the accrued liability today. Accrued liability is the discontinuance liability, which is calculated with a simple arithmetic calculation depending on the formula. So in India, the gratuity is calculated on the basis of 15/26 into your current salary into the current completed years. In this example, since my current salary is 55,000 rupees per month and my completed age is 13, hence my accrued liability becomes 4,12,500. Now, using the assumptions, the salary growth rate assumption, what I will do is that I will keep on projecting that year on year, what would be the increase in the salary of the employees, and accordingly, what is the increase in the accrued liability of the employees. Out here, we are not changing the completed year of service, because as per the standard, we need to follow only the liability, only the past service that has been given till date. For the future service, we would be recognizing the cost as and when the service has been incurred. So out here, using the salary growth rate, we are escalating our current accrued liability year on year. So in this example, since there is no mortality, no attrition rate, we are sure that this 4,12,500 will be compounded at the rate of 1.075% for the next 20 years. And at that point of time, we'd be this employee would be retiring and would be getting his gratuity amount. This gratuity amount that he would be eligible for at that point of time will be the payout that would be made to that particular employee. Now this particular payout that is supposed to be made at the age of 60 to this employee is 20 years from now. Hence, we will be again using the discount rate to arrive at the present value of obligation, and thus we will be discounting it back at the rate of 7% for 20 years. Thus, the formula to arrive at the actuarial valuation, actuarial liability, would be the current accrued liability multiplied by 1 plus 1.075 divided by 1.07 raised to the power 20. So out here, since we are escalating the liability at the salary growth rate assumption, hence we have kept the salary growth rate at the numerator, and the discount rate, since we are using it to calculate the net present value, we are using it as the denominator. And thus we are arriving at the actuarial liability, which is 4,52,812. Out here, if we are incorporating or introducing the concept of attrition rate or mortality rate, this payout that is expected to be made after 20 years will be paid out before that. And hence, our liability in this case will reduce because our salary growth rate is higher than the discount rate. So that simply means that instead of 20, since we are increasing our attrition rate and mortality rate, this figure will reduce from 20 to maybe 15 or 10. So longer the projection, higher is the liability. Lower the projection, lower would be liability for this particular example. In the slides to come, we will see other examples, other scenarios also. Move on to the next slide and understand that how sensitivity plays a role into this liabilities. Moving on to the slide, out here we have tried to explain that how the discount rate and salary growth rate is impacting your liability. A change in discount rate. So if whenever we are discount increasing the discount rate, we are increasing the denominator in our previous example. Hence, any increase in the discount rate will result in a fall in the actual liability, whereas any decrease in the discount rate will result in an increase in the liability. On the contrary, salary growth rate, since it was a part of the numerator in our previous example, any increase in the discount in the salary growth rate will result in an increase in the actual liability too. So if we have to say, we can simply say that salary growth rate is directly proportional to our actual liability, whereas discount rate is inversely proportional to our actual liability. I'll try to explain this with an example also. Moving on to the next slide. I have assumed the salary growth rate of 8.5%. All other assumptions are kept consistent. The salary is still 55,000. The current age is still 40. Retirement age is still 60. Completed year is still 13. So the accrued liability is still 4,12,500. However, if you will notice, in the actual liability calculation, instead of 7.5%, we are assuming a salary growth rate of 8.5%. And hence, my actual liability has increased from 4,52,000 to 5,44,000. So this simply states that any increase in my salary growth rate is resulting in an increase in my liability. Similarly, in the next slide, we are going to see a fall in the liability because of an increase in the discount rate. Out here, we have increased our discount rate from 7% to 8% per annum, which is resulting our liability to fall from 4,52,000 to 3,75,940. Interestingly, if you will see out here our discount rate has increased from salary growth rate. So whenever my discount rate is higher than my salary growth rate, I would expect my actual ratio. Actual ratio is simply the ratio of actual liability is to accrued liability. So whenever my salary growth rate is higher than my discount rate, we would expect our actual liability to be higher than 100%. And whenever my salary growth rate is lower than my discount rate, we would expect the actual ratio to be lower than 100%. But obviously, there are other factors like attrition rate, mortality rate, the limit on gratuity scheme, which might impact this ratio. And instead of 100%, we might assume a lower ratio out there too. But if all other assumptions or all other parameters needs to be ignored and we need to talk purely on the basis of salary growth rate and discount rate, this is what our expectations would be. A higher salary growth rate will give us a higher liability, a lower salary growth rate will give us a lower liability. Talking about the demographic assumptions in the next slide. Demographic assumptions, as we saw in salary growth rate and discount rate, there was a direct relationship, be it inversely proportional or directly proportional, but there was a direct relationship with salary growth rate and discount rate. However, for demographic assumptions, including the attrition rate and mortality rate, the relationship between liability and these assumptions are not direct. It is on the other hand dependent on the relationship between salary growth rate and discount rate. So in the general case, when the discount rate is lower than the salary growth rate, an increase in the attrition or mortality rate will result in a fall in liability. Why is it happening? See, whenever I am increasing my attrition rate, in the previous example where we saw that the attrition rate was 0%, my expected remaining working lifetime was 20. When if I increase my attrition rate from 0 to 10%, my expected remaining working lifetime may be, hypothetically, let's assume, will reduce to 10 years. So in that particular scenario, my liability will also reduce because the numerator is higher than my denominator. And because of this particular reason, an increase in attrition rate or mortality rate will result in a fall in liability in scenarios when salary growth rate is higher than the discount rate. Just on the contrary, if the salary growth rate is technically lower than the discount rate, then we will see an opposite direction happening out here. Moving on to the next slide. There are few conditions which if they're applicable will not the previous scenario will not hold true. I'll just explain you why the previous scenarios might not hold true because of this particular reasons. So as I just mentioned, that an increase in the attrition rate will result in a fall in liability in the first scenario. However, if the vesting condition also needs to be played around, because of a fall in attrition rate, the probability that the employees will actually touch the, I mean to say, vesting condition will also increase. right? So because of that particular reason, we might see an increase in liability. Similarly, because of a fall in attrition rate, the person who were capped at 20 lakh rupees of limit will now get the payment at a later point of time. Because of this particular reason, your liability might fall. So when I am talking about gratuity scheme, because of this particular reason, my previous assumptions, my previous analogy might not hold true. But other than this, and this would consist of 99% of your actual valuations. If you would be taking care of all these three assumptions in a gratuity valuation, you would be probably trying to explain, or you would be able to explain almost all your ratios out here. In the leave calculation, the availment rate and the encashment rate plays a role. So, other than your rate, and also what is the relationship between the encashment salary versus the availment salary will play a role. So please keep in mind, while doing a natural valuation for gratuity, to keep in mind that how vesting condition and gratuity ceiling limit is impacting your liability, and for leave valuation, how your encashment and availment rate is impacting your liability. Other than that, you might refer to our previous slide and understand that this is how your actual liability will move when your demographic assumptions are also moving. In the next example, we would try to explain you the calculation out here. So in this particular scenario, we have increased our attrition rate from 0 to 10%. Out here, you will see all the assumptions are still the same. The salary is 55,000, the current age is 40, the retirement age is 16, the completed age is 13, salary growth rate is 7.5%. That was our initial assumption. The discount rate was 7%. So in that particular case, our actual liability was coming to be 4,52,812. So when the attrition rate was 0%, we were seeing the liability to be 4,52,812. As we increase our attrition rate from 0 to 10%, we saw a fall in our liability. So the actual ratio reduced from 110 to 105%, and our actual liability reduced from 452 to 432. Please note that in this particular scenario, my salary growth rate is higher than the discount rate. In the next slide, we will again see a similar example where, but the discount rate would be higher than the salary growth rate. Can we move to the next slide? Yeah. So in the next slide, since the salary growth rate is lower than the discount rate, we saw that increasing the attrition rate actually increased my actual liability. In the previous scenario, my actual liability was reducing. In the current scenario, my actual liability has increased from 375 to 393. So that is how our actual assumptions are playing a role, and a change in the attrition rate is impacting your actual liability.